Hi, it's John Klotz, host of Money Talks Media. Welcome back. We have our good friend Brad Hughes of Excel Funds, and we today at Money Talks Media are talking emerging markets. Brad, we've been kicking around the idea of some of the opportunities that exist for people, and I do want to talk about some of the key countries like China, India, Brazil, and Russia, which constitute the BRIC countries. But you mentioned to me while we were on break some of the income products that are coming out there that may have a little less volatility and a little bit more opportunity for income. Go ahead, maybe you could address those.
Sure, absolutely. Up until last year, the Canadian investor didn't have emerging market bond portfolios really available to them. 12 years ago, you probably wouldn't have wanted to touch the bond market in emerging markets. But it's a very different environment today. We have seen the financial or the fiscal stability in these emerging markets, and a lot of the corporations there go in the opposite direction of the developed markets, the US, Europe, Canada, whatnot. And so what we find today is that is a very great opportunity that is now available to Canadians. It's available in Europe and other countries around the world since 1999 or earlier. And so, yeah, now we have brought that market to investors in Canada. And you're right, it's a less volatile way to play the emerging markets. And
how's that? It's a bond. It consists of some corporate bonds or some government bonds.
It is made up of government and corporate. It'll be up to 50% corporate bonds. So right now we're probably about 37%, 35% corporate bonds in the portfolio. The rest is sovereign or government debt.
And the remaining, so it's 100% bonds.
It's 100% bonds.
Whether corporate or whether government bonds.
That is correct.
I see. And where are they focusing? Which countries is it focused in?
It is a global mandate.
Okay.
It's around the world. They're going to go wherever they can find the best opportunity, and that doesn't necessarily mean the best yield.
Yeah.
A lot of considerations go into this. Our portfolio manager is based in Europe, and they manage about 1 trillion Canadian dollars, a trillion, not a billion. Canadian dollars. They're the 8th largest asset manager in the world. And we know that investors like that income. Every month they get paid. It's almost like removing risk. You're getting paid every month. We have 2 versions. One is a high income for your registered tax sheltered plans. And then we have the capital income, which is for those non-registered investors, which will distribute your monthly distribution in form of capital gains. So at the end of the year on your tax filing, you're going to save considerable amount of money because you're not claiming income, you're claiming capital gain.
Which is return of capital. Is it return of capital or is it capital gains?
No, it is not return of capital.
Okay.
It's capital gains.
Instead of income or interest or dividends.
That's right, yes.
Okay. And what... Now that's interesting. How do they do that? How have they set that up to produce capital gains?
It's a very complex structure done with one of the chartered one banks in Canada, and they've done this for a number of funds within the Canadian marketplace. Okay. And it's a swap agreement, if you will, where they convert our income, they absorb that, and they distribute capital gains to us or our unit holders. So again, very tax advantaged, US dollar, Canadian dollar versions. What I like about the emerging market bond portfolio is that the clients can, earn their 6.5% depending on the NAV where that is, and then
how do they do that? Is that through distribution? You say 6.5.
That's monthly distribution, 2.5 cents
capital gains.
In capital gains.
Interesting.
Yes, and quarterly, semi-annual, annually, we're going to be able to top up with additional payments. Depends on how well the portfolio does, but we're going to top that up. And we will also strive to earn the client. They're getting their 6%. We'll use a round number. They're getting their 6%. We're also going to strive to give them another 1 to 2% from currency appreciation, another 1 to 2% from capital gains of the bonds.
So are we suggesting a 10% potential rate of return without taking a lot of risk? Is that accurate? I really want to know about that. That's
the European portfolio that they've been managing since 1999 has averaged 11.77% return.
On bonds.
On bonds. Now, I am here to say to the Canadian investors, let's look at your 6%, which you're getting, a little bit more perhaps right now, and let's shoot for 1 or 2 more extra percent. And if you can achieve your 8% on your income product in the portfolio, that's a very attractive gain.
It's very attractive. I mean, we've been talking to our clients for years. If they can get an 8% rate of return, they're very happy without taking a lot of risk. Some of the, as you know, there's some of the income plus type products which are guaranteeing 5 and 6% distributions. And that's not bonds. There's a lot of equities in there.
Yes.
That's a very interesting proposition. What's the risk, though? Is there potential failure on the ability to pay back the loans? And
absolutely. I think that's in any of the bonds
Yep.
and anywhere in the world. I don't think you're taking on a much greater risk. I would say that you're probably taking on less risk because a lot of these economies, a lot of these corporations and countries have really become fiscally prudent over the last decade, opposite of what we've seen in the developed markets. The reason I think that we're getting better yields too, one of the reasons in North America, the developed markets, the US, Europe, we're in a position where we need to encourage economic growth. In order to do that, one of the policies that we expect to see is lower interest rates to help spur that on. In the emerging economies, they're much faster growing. And because of this quick growth, one of the side effects is inflation. And in order to balance out that inflation and keep it in control, you do have to have higher interest rates. And so that's why you're getting some of these higher yields. And what we expect, what we're seeing is obviously the older demographic in the developed markets is really going to be searching for income increasingly going forward. They're going to go close to home first. It's what they feel safe with. It's what they know. That's going to put a lot of pressure on those yields that are already low. The emerging economies, they're high. They are going to be coming into demand a little more as we go forward. As an example, the top 8 or 9 pension funds in Canada have somewhere between 2 and 3% emerging market bonds. Outside of that, there's negligible in the rest of the pension plans. And our manager, Amunde, is out talking to some of these Canadian managers, trying to, build a partnership. And there hasn't been a lot of desire until last year when these pension managers returned Amunde's calls and said, look, we have a problem. The liabilities on our pension fund, from the inflows, there's a discrepancy. We need to increase our yield to help pay out the pension requirements. So now you're starting to see a bigger interest from pension plans into these markets. And now from 15 years ago or so, when you had 12% investment grade rated, 15% investment grade rated emerging market bonds, it's now over 50%, much stronger. And I would suggest that there's been a lag in reassessing, if you will, the strength of the economies and the corporations that we're investing in. And what's going to happen going forward is the rating agencies will start to come back to these bonds, reassess their credit rating, and improve it, which will put growth in the investors' portfolios as well.
so when someone looks at the printout of what bonds these emerging market bond funds is holding, where's the key countries that it's held in? Where, like, if you could pick the top 4, where's principally the bonds being held?
And here's where we get into, when we look at the fund sheets, some of the things will show you where we buy, because currency is important. And in our equity portfolios, we don't hedge the currencies because we expect the equities to give us strong double-digit returns over time. We expect the currencies to appreciate. When you're dealing with a yield product, a bond market, we think currency management is extremely important, and we will hedge these currencies. Some of them we won't. If we go into perhaps a Brazilian real, we don't hedge that currency. But in December, for example, we bought a Gazprom bond. I believe it's about a 9% yield. But we bought it in US dollars. The manager doesn't like US dollars, so they hedge that currency out against one of the currencies they do like. And they hope to get, roughly, as I say, over the year, 1 to 2% gain or growth in the portfolio from currencies. And as a matter of fact, in January, they had a gain of about 0.5% from currency alone. So the Russian market is in there, looking at just some of the top bonds as opposed to countries. Turkey, Brazil, Indonesia. Those are some of the areas where this group is looking. They go around the world. There's no stone unturned.
So in a nutshell, who would be interested in looking at one of these income bond type of portfolios? What's your investor profile look like?
Well, you know what? I think from the perspective, you being an advisor, you understand the clients very well. Most of the portfolios you have would be a balanced, diversified portfolio, some equities, some bonds. This is another way to diversify, to take your income. If you've got a portfolio with 20% income, you take 5%, put it into the emerging market bond. If you've got clients who want emerging market exposure, they're not ready for the risk of the equity. This is a way to transition in. Or best of all, you buy the emerging market equity fund, and you pair it up with the emerging market bond fund. You've created your own balance fund.
You create your own balance fund.
$5,000, you put $3,000 in the equity, $2,000 in the income fund. You watch that, and you're going to have a lot less volatility with some strong growth.
Excellent. We're going to take a quick break. We've got Brad Hughes here from Excel Funds. Our little caveat, of course, always speak with your advisor before making a move on an investment strategy. But we've been talking about an income bond fund in the emerging markets. We'll be back in 2 minutes. Thanks.
Thanks.